my friends out there and my students. I remain my humble self. I can be your tutor on financial accounting. Let's do justice to this topic. To this question above. The question is all about business accounting. Look at the question. Let's look at it critically. Olubenga bought goods worth 800 naira and sold at a margin of 20% on selling price. How much did he sell the goods? Now, anytime you see a question like this, bearing margin, and the question is asking for the selling price, margin and markup, they are one of the instruments that we use in accounting in this type of question. Anytime you see a margin in a question like this, the first thing first you have to do is to convert this margin to markup. So that's the only way you can get your answer, you can get your selling price. And what do we do? Let's look at the solution, suggested solution. Now, as a layman, first thing first, you must be able to understand what's the meaning of margin and what's the meaning of markup. We are converting margin to markup now. You must be able to know what markup and margin is all about. Now, margin simply means a relationship between the profit and the selling price. That's the meaning of margin. The relationship between the profit and the selling price. Why markup is just the relationship between the cost price and the profit. The cost price and the profit. Now, the reason why we have to convert this margin to markup is that, I told you that markup means the relationship between the cost price and the profit. And if you look at the question, they have given us the cost price. So once they have given you the cost price and they did not give us a direct figure for selling price, that's why they said we should calculate the selling price. We are given the cost price, and that's the reason why we don't have any choice than to convert this margin to markup, because we have to convert it to markup so that it can make our work easier, because they have already given us the selling price. Now, how do we do it? Look at the margin now. The margin is 20%. The margin given to us is 20%. And in fraction, 20% means 1 over 5. You want to convert it to fraction. 20 over 100 will give you 1 over 5. And mind you, we are converting this 20% margin now to markup. And the rule says that anytime we are converting margin to markup, we subtract the denominator by the numerator. We subtract the what the numerator given to us from the denominator. That will be 5 minus 1. That will give us 1 over 4. We have converted to markup like that. 1 over 5 minus 1, which is 1 over 4. But had it be that we are converting markup to margin, that will be addition. You had the figure given to you in the numerator with that of denominator. That will be 1 over 5 plus 1, that will be 1 over 6. But in this case, we are subtracting because we are converting margin to markup. Now, having done that, you now bring the equation out. That will be 1 over 4 is equals to P over CP. The P here means profit, and the CP here means cost price. The 1 over 4 that we have gotten here as our markup, 1 over 4 is what we use here. 1 over 4 is equals to P, which is profit over cost price. And if you look at the question very well, they have given us the cost price. Olubenga bought goods worth 800 naira. So the cost price here is 800 naira. So we now say that, okay, 1 over 4 is equals to we don't know profit. We have to calculate profit over CP, which is 800 naira. So we cross multiply. So if you cross multiply, that will give you 1 times 800 is equals to 4 times P. That will give us 800 is equals to 4P. So in mathematics, for us to get this P, which symbolizes profit, we have to divide both sides by 4. So that will give us P. So this one, we divide this. So our profit will now be 4 divided by 800. That will give us 200 naira. So having known that, we have to calculate our selling price. How much did they sell the goods? Now, in the process of calculating our selling price, we know that in mathematics, the formula for calculating selling price is equals to cost price plus your profit. That's the way they taught us in our primary school and in our junior secondary school. So our selling price here is equals to cost price plus profit. And mind you, we've already known our CP, our cost price as 800 naira. And we have gotten our profit here, which is 200 naira. So our selling price will now be 800 naira plus 200 naira. So definitely our selling price will now be 1000 naira. So as simple as that. So now, having known this, let me recap what I've done. I told you that anytime you are seeing a question like this, the first thing first, you look at it that are we giving markup or margin? If we are given margin and we are expected to calculate the selling price, that means we have to convert margin to markup. But if we are being given markup, so automatically they must have given us the selling price. They will ask us to calculate the cost price. So we now convert from markup to margin. And I've told you that when you are changing from margin to markup, you will subtract the numerator from the denominator, which is what we are doing here. But if you are converting from markup to margin, that means you have to add from margin to markup. And I've told you the meaning of margin, that margin is a relationship between the selling price and the profits, while markup is the relationship between the cost price and the profits. And this is what we have just done. We convert this 20% to markup and we arrive to 1 over 4. So we bring it out, we apply the formula. 1 over 4 is equals to profit over cost price. 1 over 4 is equals to profit over the cost price given to us in the equation, which is 800. That's 1 over 4 is equals to P over 800. So we cross multiply. So that gives us 800 is equals to 4P. We divide both sides by 4. And that's how we got P is equals to profit is equals to 200 naira. And we bring out our formula here, which says that selling price is equals to cost price plus profit, so as to get our selling price. The question says that we should calculate how much they really sell the goods, that is the selling price. So that's how we arrive to 800 naira, which is the cost price, plus the profit, which is 200 naira. So selling price is equals to 1000 naira. Now, having done that, let's move to there is a particular topic in accounting that our students they find it very difficult to understand, and this is a topic that is very important in accounting, and we call that topic trial balance. We call it trial balance. So some of our students they normally find it difficult to understand what trial balance is all about. Trial balance, and it's very simple. It's very simple. Now, when we are talking about trial balance simply means an extraction of balances from ledger. Extraction of balances from ledger to uh, ensure that to prove the arithmetic accuracy of double entry principle is an extraction. What we mean by extraction is that what you take out from the balances of ledger. When you prepare your ledger and all those balances that you derive from it, you are trying to prove the accuracy of whether it's correct or not. That's why we say that trial balance is a list of balances, whereby we extract the balances from the ledger to prove the arithmetic accuracy of double entry. Prove the arithmetic accuracy of a double entry. Now, anytime we are solving trial balance, or let me give you a definition of the board so that some of us we can learn from it. Now, when we are saying trial balance, we are saying trial balance uh, is a is an extraction of balances from ledger to prove arithmetic accuracy of double entry. That's what we call trial balance. Now, to simplify it for us, so that we can understand it better, there's what we call, there is a rules we use in trial balance. We call it, the rule says the DAPC. That's the rules. And these DAPCs, we must understand what it's all about. This DAPC in the rules of trial balance is what we call, this D means debit, assets, expenses, purchases, credit, income, liability, and sales. This D represents debits. This D represents debits. A represents assets. E represents expenses. P represents purchases. C represents credits. I represents income. L represents liability. And else represents sales. Now, the rules of trial balance now, there's what we call, this is how to do trial balance. This is what they call trial balance. What they are saying here is that your totality from debit side must be equal to your totality in your credit side. That's what they call balance. That's why they call it trial balance. It must balance. What you get at your debit side must be equal to what you get at your credit side. And this side we call it particular. Now, the essence of this formula or these rules that I've just itemized here is that once you have known this rule, that you have to, anytime you see assets, expenses, and purchases, you debit it. And this is what they call debit. Your DR, debit. That is, it will be at this side. It must be at this side. But anytime you see income, that's why we say credit, income, liability, and sales. So anything income, liability, and sales must be at the credit side. That's the rules that you and I must understand in accounting. Now, having known that, as an accountant or a commercial student or a social science student, you must be able to identify what an asset is. You must be able to identify expenses. You must be able to identify purchases. You must be able to identify income. You must be able to identify liability. And you must be able to identify sales. So these are the important things that you must be able to identify. Because if you cannot identify it, what's the essence? So that's the elementary aspect of accounting. Now, having known this, we say that debit asset, an example of asset, we can say furniture. Furniture is an asset. Okay, so let me put it in this way, sorry. I'm just trying to explain. I will not be putting figure there. So I'll just be putting something like this. Uh-huh. So anywhere you see furniture, you know that furniture is an asset. Like this marker board I'm using an example of furniture. So furniture we can categorize it as an asset. That's what we call motor van too. Motor van is an asset. The vehicle that we use for our business, that's what we call motor van. The vehicle used to carry our goods from one place to another. That's what we call motor van. We use motor van for business purpose. So now there's what we call expenses. I'm talking about those one at the debit side now. There's what we call expenses. If I say that rent now, the amount you use to to get your shop rent is an expense. It's an expense. So it must be stated at the debit side. So when we are talking about stationery too, stationery like your pen, your writing material, that's what we call stationery. They will be at the debit side. Then there's what we call maybe you bought something, call it purchases. Anytime you have purchases, purchase an item, it will be at the debit side. Now let's move to the credit side now. So I'm done with assets, expenses, and purchases. Now let's go to the credit side. There's what we call income. Now, anytime we have commission received, that's an example of income. Commission received. Commission received, that will be at the credit side because it's an income. We all know what commission is. Assuming that I am into the sales of books now. Maybe I'm selling a financial accounting textbook and I give it to somebody to sell on my behalf. And that person now sold, let's say 20 copies. So I have to give the person the reward for selling those 20 copies. So the entitlement, the money given to that person for selling that 20 copies of textbook on my behalf, that's a commission. That's why we say commission receipt is an income. There's what we also call uh, rent receipt too. Maybe I have a shop now and I'm collecting money on that shop, on that room or two or three room apartment that I lease out for rent. So it's an income too. Call it an income, rent receipt. Then let's move to liability. Liability, they are your indebtedness to the outsiders. The money that your company is owing the outsiders. So that's what we call the liability, like your creditor now. Creditor, you are owing your suppliers. Creditors is an example of a liability. Bank loan, you are owing your bank money. That's an example of a liability. They will be at the credit side. Then let's leave that one. There's what we call sales. If you have your sales now, you sold out 100 bags of cement, that's sales. So that one also will be at the credit side. So these are the simple things that we have to know as far as trial balance is all about. As far as trial balance is all about. So what they are saying here is that there's also what we call, anyway, let's leave it like that. What they are saying here is that your debit side must be equal to your credit side. They must balance. It must balance. But at times we may have what we call capital too. If we are being given capital, so our capital will also be at the credit side. Your capital, the money that you use to start a business, that's what we call capital. So by the time you do the summation of the debit side, the summation of the credit side, you must arrive to the same figure. The same figure. That's why they call it trial balance. It's an extraction of balances from ledger to prove arithmetic accuracy of double entry. Now, what do we call ledger? Now, ledger is a principal book of accounts where all our balances, all our accounting are permanently recorded. That's the meaning of ledger. Ledger is something like this. Let's say that we have something like this rent account. You have rent account. This is an example of ledger. And we have balance. Let's say we have balance brought forward here. Let's say we have 500 naira and balance carried down here. Let's say we have 400 naira. So, and we have our, let's say we have our cash. This is our cash around here. Let's say we have 900 naira. We do our, call this one our income and expenditure. That is what we go to our P&L account. So when you add the two together, I'm just trying to give you an example of a ledger. So now what we make, when we subtract 500 from 1,300, that should give us 800. So it must be the same thing. Now, assuming that we are preparing to our balance now, if we want to remove, we want to extract the what we get here to our chart balance. This is what we are going to use. This balance carried down 400 naira, we change it to balance brought down here. So it is this 400 naira that we are going to take to our chart balance. Is what we are going to use as rent here. As rent. The rent we are going to use here will now be 400 naira. So that's what we are going to use. So we treat this as our chart balance. We take these balances. That's why we say extraction of balances from this ledger. Extraction of balances from ledger to prove arithmetic accuracy. That is, the two sides are they equal to each other? Do they balance or not? That's what they call chart balance. Am I communicating?
Yes, sir.
So now let's quickly, because I want us to learn one or two things, and let's use this one as the last topic before we call it a day on this episode. Before we move to another subject. Another thing, because these are the foundations in accounting. There are students they don't really understand, and they must understand it if they want to go far as this subject is concerned. And there's what we call accounting equations. Some of our SS1 students they don't understand it at all. There's what we call accounting equation. If I'm not good at this subject, I cannot be teaching you fund. So it's because myself, I also take time to study and to learn. Now look at this. Now there's what we call accounting equation. Equation is just, it simply means the equation that we use to solve accounting problems. They are equations that we use to solve accounting problems. That's what accounting equation is concerned. And then there's what we call, and for us to get this equation, we must know the formula to calculate assets. We must know the formula to calculate capital. We must know the formula to calculate liability. Now, having known this, we are good to go. Now, our asset, the formula to calculate our assets will now be capital plus liability. Capital plus liabilities. We all know what an asset is. An asset, they are properties of business. They are properties that we use in the process of starting business. So that's why we term it as the properties of business to a layman. So for better clarity, can say that an asset, they are properties of the business and they can be divided into two. We have current asset and fixed asset. Fixed asset, they are assets that has a durability, a duration of more than 1 year, they are usable for more than a year. That's the meaning of fixed asset. They can stand the test of time. So they are capital in nature. That's what they call a fixed asset. But current asset, they are assets that can be easily converted into cash. If you need money now, you can easily pick it up and go and sell it and get your money. So their own durability is not up to a year. They are less than 12 months. So your current assets are usable within 12 calendar months. So any asset that is beyond that is a fixed asset. So, but any asset that its duration is between uh, day 1 to 12 months. That is less than a year. The durability is less than a year. That's what we call current asset. Capital is your equity. Is what you use to start, you use to your investment, the amount you invest into your business. That's what they call capital. So capital is simply means the money that we use to start a business. Then liabilities, they are your indebtedness, the money you are owing the outsiders, the money you are owing your suppliers, the money you are owing your creditors. That's what they call liabilities. So that's what it's all about. So our asset is equals to capital plus liability. Now, having known this now, is the same equation that you are going to use to get all this to capital and your liability. Now, when your asset is capital plus liability, automatically your capital, when your liability comes in, when it crosses gather, that will come to assets is equals to, asset minus, when it comes here, it comes to minus liability. That's your formula. These are things that we have to understand as a student. Then liabilities, same thing. It's going to be assets minus capital. That's the formula for calculating liability. So far so good. You have known the meaning of asset. I said it's divided into two: current asset and fixed asset. Then we have known our capital too, the meaning of capital. So the amount you use to start your business. Liability, the amount of money you are owing the outsiders, your suppliers, your indebtedness, the, the indebtedness of an organization. That's what we call liabilities, such as bank loan, creditors, debenture, company loan, and so on and so forth. So um, let's ensure that we subscribe, let's ensure that we like, let's ensure that we share so that we can understand some educative, informative, and comprehensive knowledge as far as accounting is concerned, as far as economics is concerned, as far as mathematics is concerned, as far as English studies uh, is concerned, and all other social sciences. So, same time, same station, same page, same YouTube page, same platform. Have a beautiful day. God bless. Thank you.